all must have seen the latest news regarding central bank tightening monetary policies amid fears about imminent recession. Now, what is this monetary policy? Why does a country requires monetary policy? Who creates it? What exactly is the goal of monetary policy? What tools are employed? Let's study and grasp all these key topics involved with monetary policy in this video lesson. Now, hello everyone, I am Dr. Durdana Oves from Department of Commerce, the Bhopal School of Social Sciences. Monetary policy is an economic policy that manages the size and growth rate of money supply in the economy. The monetary policy relates to the central bank's policy on interest rate, money supply, credit availability, and it is a policy that is developed by the central bank, that is the Reserve Bank of India, and is concerned with the country's monetary affairs. That is, the central bank plays a crucial role, and this central bank implement the policies through different tools. These tools are basically for controlling money and credit supply in the economy. As such, we can say that monetary policy is an economic policy that manages the size and growth of money supply. It is a policy on interest rate, money supply and credit availability. It is developed by the central bank and it is concerned with the changes in the supply of money and credit, and these policies are implemented through different tools. Now, why a monetary policy is required? See, if the needed money supply for the economy is not available in the market, investments in the economy is going to decrease. On the other side, if the money supply is in the economy is excessive or it exceeds what is required, then the lower sector of the economy will suffer. The poor will suffer as the prices of crucial items will increase. That is, the money supply is in the economy that is regulated by the central bank. How it is regulated? It is regulated through the monetary policy, because if the money supply is going to decrease, then these shops will be closed. Now, based on this introduction, we can say that monetary policy is an exercise of central bank over the money supply as the instrument for achieving objectives of the economic policy. Now, in this definition, there are certain keywords. A central bank. What is a central bank? A central bank is a financial institution in charge of our country's money and credit creation as well as distribution. Second comes money supply. What is money supply? Money supply represents the total amount of money in circulation like cash, coins, bank account balances. All these are referred to as money supply. Next comes instrument. It is called as an instrument because it helps in achieving something. Now, what is this something? These something are the economic objectives of the economic policy. So, what is an economic policy? Economic policy refers to the government's actions that are intended to influence a city, maybe a state or a country's economy, and it is done by setting tax rates, interest rates and government's expenditures. Now, based on this definition, we can conclude that there are four major objectives of a monetary policy. The first objective is full employment. Monetary policies have the power to impact the degree of unemployment level in the economy. For example, when an expansionary monetary policy is adopted, it reduces the level of unemployment. How? Because it increases the money supply, and the money supply in turn increases the level of economic activity, which leads to market expansion. Next comes price stability. A low amount of inflation is always thought to be beneficial for the economy, as it depicts that the economy is growing. But when the inflation is high, a policy to reduce the amount of money in the economy is adopted. This helps in reducing the money flow in the economy. Third comes economic growth. Monetary policy can promote economic growth by making borrowings more affordable and accessible. The easy availability of credit at a lower rates of interest encourages investments, and it also increases society's productive capacity. This in turn allows the economy to develop at a greater pace than previously. Last objective is exchange rate stability. The exchange rate system is also an important part of the monetary policy in an open economy especially. Under the current floating exchange rate system, the central bank must make appropriate monetary measures to prevent large depreciation or appreciation of the currency, that is rupees, in terms of US dollars and other foreign currencies. This is taken care by monetary policy. Now, having seen the objectives, let's discuss how the monetary policy achieve these objectives. The monetary policy achieve these objectives through tools, through instruments. The instruments of monetary policy are two types: qualitative and quantitative. These tools helps in regulating the aggregate demand through supply of money, cost of money and availability of money. Let's see the qualitative tools first. The first qualitative tool is margin requirements. The central bank is empowered to fix the margin and thereby fix the maximum amount which the purchaser of securities may borrow against these securities. As such, when the margin requirements are changed, the amount of loan that is available, the amount of loan that can be given is altered. The second is consumer credit. Consumer credit regulation is concerned with establishing rules for payments and maximum maturity period. It utilizes two devices, a minimum down payment and a maximum payment duration. Next comes guidelines. Include directives given by the central bank to commercial banks as well as informal and voluntary agreements between the two. These directives may take the form of oral or written declarations, appeals or warnings within the goal that is set by the central bank. Next comes rationing of credit. This includes a selective strategy which is used by central bank to restrict and regulate the purpose for which commercial banks issue or allocate credit. This ensures that the financial resources are diverted through desired channels, like a limit is being set of how much loans can be given to a particular category. Then comes the last qualitative tool, that is moral suasion. Moral suasion refers to central bank's appeal and request to commercial banks regarding the monetary policy. The central bank may also encourage or suggest the commercial banks to maybe refrain from seeking further accommodation for financial assistance. Moral suasion is in reality a psychological method of regulating credit. Because it is totally informal, its usage is not governed by any laws. Now, let's have a look at the quantitative tools. The first direct quantitative tool relates to CRR, cash reserve ratio. It is the deposit ratio that banks must maintain with the RBI. CRR requires that a specified percentage of total bank deposits to be held with the RBI's current account. Banks do not profit from this, That is, they have to keep a certain amount with the RBI in its current account, but they do not profit, they do not have access to this amount for undertaking any economic or commercial purpose. That is CRR. Next comes SLR, Statutory Liquidity Ratio. Apart from CRR, banks are required to invest a set percentage of their deposits in designated financial instruments such as central government or state government securities. This proportion of how much is required to be invested is referred to as SLR. The money that is invested in SLR is mostly in government securities, which means the banks do receive something in return as interest. Then comes the refinance facilities. Refinance facilities are sector specific refinance facilities which are given by the RBI to banks. Let us see the indirect tools. The first indirect tools refers to repo rate. It refers to the interest rates at which the RBI loans money to commercial banks in exchange for the promise of government assets whenever the banks want funds that are required for their day-to-day commitments. Banks enter into an agreement with RBI to repurchase the same pledged government securities at a certain price at a later date. These loans are often for a brief period, that is for 2 weeks, and repo rate is actually an abbreviation of repurchase rate, that is the rate at which the RBI will repurchase these securities. Then comes reverse repo rate. Reverse repo rate is the rate of interest given by the RBI when banks deposit excess cash with the RBI for brief periods of time. When banks have excess cash but no lending or investment possibilities, they deposit this cash with the RBI. Then comes bank rate. Bank rate is the interest rate at which the RBI loans cash to commercial banks. The bank rate, unlike the repo rate, does not include a repurchase commitment. Then comes MSF. MSF stands for Marginal Standing Facility. This is a mechanism through which commercial banks can borrow from RBI against government securities on an overnight basis for emergency purposes. Then comes base rate. The base rate is the minimum interest rate below which the banks are not authorized to lend. The base rate includes all aspects of loan rate that are shared by all types of borrowers. Banks are permitted to calculate their real lending rates on loans and advances using the base rate. Last is OMO. OMO stands for Open Market Operations, which includes the RBI's purchase and sale of government securities in the open market. If the RBI needs to expand the money supply, it buys government's assets and securities. If the RBI has to reduce the money supply, it sells these securities in the market. Now, using these tools, the RBI or the central bank can adopt an expansionary monetary policy or a contractionary monetary policy. Now, what is an expansionary monetary policy? An expansionary monetary policy is used to overcome a recession or depression. Under this policy, the central bank eases the credit market conditions, which leads to an increase in aggregate demand, and as such the credit facility becomes cheaper. And on the contrary, there is the opposite of this type of policy, that is contractionary monetary policy, which is also called as restrictive monetary policy, which aims to curtail the aggregate demand. It is used to overcome inflation. Inflation leads to the economy experiencing pressure due to increasing consumer demand of goods and services. In this situation, the central banks adopt a restrictive monetary policy which decreases the level of consumption. And how is this level of consumption decreased? Through decrease in money supply. So, in this topic we have studied regarding the definition of monetary policy, objectives, tools. We have also studied the introduction and types. The mind map regarding this video lesson will be provided in the link that will be given with this video. That was all for today. Keep learning, keep growing.